So everyone, it's safe to say that 2025 has gotten off to a turbulent start with policy shifts and market dynamics around the US are really presenting challenges and opportunities for investors. So joining me to unpack these is Siboniso Ngumalo, who's the Chief Investment Officer, and who is going to help us understand the broader market shifts. We also have Meryl Pick, who's Head of Equities and Research, and we'll dive into the evolving tech scene in China and how it presents its poised for market opportunities. And last but not least, we also have Gustav Schulenberg, who's a Portfolio Manager, and he will share with us why AB InBev remains a compelling investment opportunity for the markets. So before we start, please do not forget to submit your questions. We are going to have a Q&A at a later stage. But before we also start with the conversation, I would like to pose a poll question to you all. So the question is around, I hope you can all see it, but it's around, in terms of Trump's tariffs, when are they likely to take an average tariff rate on all imports to highs since that were last seen around, is it 1995? Is it 1969? Is it 2001? Or is it 2010? So I'll give you a few seconds to answer that question before I'll hand over to Sibo to set the scene for us. All right, great. So I'm going to start with you, Sibo. Thank you so much for joining us. And a warm welcome to our webinar in 2025. So my first question, Sibo, is around, it's been 2 months since Trump got inaugurated in January this year, and the S&P 500 has dropped to a whopping 10%, mainly due to concerns around his trade policies. Do you think this is just a temporary dip or a sign for something more significant? Like, what's your gut feeling around what's happening in the market right now?
Hi, Masidin. Hi to all the listeners. And I think before we talk about this 10%, let's paint the context of what's happening in the market, because the 10% is one thing, but actually, where are US valuations? What is Trump trying to do? Because that's important. And actually, how do we think then that will play out? And then how have we positioned clients' portfolios on that? So the first slide I'm going to put up is our price to sales ratio for the US market. Now, if you look at this particular slide, it's from the 1800s, that the price to sales ratio is pretty high. Now, what is interesting here is, if you look at the title, we say Trump starts with some lofty expectations. So in terms of the market is expecting a lot from Trump and is priced a lot from Trump. Now, if you go to the last peaks, so there in the 1930s, before the Great Depression, that's President Hoover, he started off with some lofty expectations, and the subsequent returns actually were very poor. George W. Bush started actually in 2001 with some lofty expectations too, in the same ratio, and that was just before the tech bubble and the tech crash. And so therefore, Trump now starts at the second highest expectations in terms of the price to sales ratio. So the expectations are very high. And actually, as you can see, the US is starting to show slowing growth and slowing investor returns. So from us, when we look at it, we're saying actually, we struggle to find compelling opportunities in the US market, and actually we would urge caution because the price you're paying for the assets is too high. And if we continue with that and look at Trump, this is the second act of Trump, and I love this particular quote, because this particular quote actually frames where the world is. It talks about the age of unpeace. It's a book actually written by that title. A geopolitical order where states are too interconnected to fight an all-out war, but too discordant to live in genuine peace. And I think that's where we are. That's what tariffs are. They are wars, but they're not actual wars where people shoot guns, but actually states are fighting. And that's why we're seeing Trump basically disbanding a world order with Europe and disbanding world orders with Canada and asking lots of different questions. It's a war, but it's a different kind of war, and it's affecting markets. So why are we here? First of all, I think let us look at the US, and basically the title here says it, the trade wars and tariffs. What's at stake? Basically, this is the line on top is US government expenditure. That's a light green line. The line at the bottom is US government tax revenue. And so therefore, the US is spending beyond their means. And as you can see here, the expenditure is higher than the revenues, and that is then called a deficit. And that deficit is around 7% now, which is very, very high. And actually, Ray Dalio wrote a book about this and talked about how countries go broke, that ratio should be closer to 3% to be sustainable. But once it gets to 7%, you've got to fix it. And so therefore, if you as a person or a business are spending beyond your means, what do you need to do to adjust that? Well, you've got two choices. It's either you increase your revenue or you cut your costs. And actually, Trump is doing just that. Because at the end of the day, we must look at it and remember, Donald Trump is a businessman. So as a business person, he has to increase revenue of the country. He has to cut costs. What is that about? And actually, let's talk about tariffs in that framework. So one of the things Trump does, he talks a lot about this President McKinley and et cetera, et cetera. And if you look at this particular chart from the Tax Foundation in the US, you can see tariffs, actually since World War II, tariffs have really been non-existent, except for now. Tariffs are obviously coming back. But before then, tariffs did exist as a mechanism of generating revenue. You can see the tweet by Erica York, who works at the Tax Foundation, says, tariffs increases tax revenues, the ones that are proposed to Mexico, Canada, and China, will increase revenue by 1.1 trillion from 2025 to 2034. So actually, what is Trump doing? The tariffs are a means of increasing US revenue. And so that's why. So again, increased revenue. But if we look at tariffs, again, if we just step back a longer term history, this is from the 1700s. Actually, where does government get revenue? Whether it's the government in America or government in South Africa, governments get revenue these days from taxation. We saw a big hullabaloo in South Africa about increasing VAT because the South African government was trying to raise revenue. But if we step back and look at the US, back in the days, for a very long period of history, governments actually got revenue from tariffs. They did not get revenue from taxes. Taxes only showed up after World War II. And so therefore, what is Trump doing? Trump is taking the world back to an alternative universe of getting, I suppose, government revenues. He's trying to say, hey, can't I apply what used to work historically, which is tariffs? Just that now we obviously are in a generation that is completely unfamiliar with this, but this was fairly normal for a long period of time before globalization obviously took place. The trick, though, with tariffs is that, remember, there are two sides to this. You increase revenue with tariffs, but also you've got to cut costs. And so therefore, on the left-hand side here, you can see Trump is cutting costs too. So you can see US aid freeze. When you're freezing this aid, you're stopping spending money, you're cutting costs. The second one, you can see there Doge, the government efficiency with Elon Musk. At the bottom, they want to cut 1.1 trillion in terms of costs. So therefore, again, they're increasing revenue with tariffs, they're cutting costs with efficiency and stopping all this aid. The trick is, though, in this particular market, which is why the market, Mercedes, is getting very jittery, is that this is Trump's second act. And actually, the market or the world has learned how he acts. And so therefore, we're seeing much better and much more aggressive retaliations from the world. We can see that with Canada hitting US with 21 billion in retaliatory tariffs. And on the right-hand side, those two charts, you can see in his first trade wars, Trump, there was, some form of retaliation, but it wasn't meaningful. This time, the retaliations are 10 times bigger than they were in the first time. So the market is getting nervous because they're saying, well, yes, the US can ask for tariffs, but actually the world is also saying, oh no, we are going to hit you back in terms of those tariffs too. This is both from big trading partners, the EU and Canada. And so what is Trump doing? Again, increasing revenue, but also cutting costs. But the problem is, it's not that simple anymore. And that's why the market is getting nervous. So now, why all of this? What is the real issue that's putting pressure on Trump? On this chart is a US central government debt level. And you can see, again, that government debt peaked in the 1940s after World War II. Wars are expensive. And therefore, to fund wars, actually, you've got to borrow a lot of money. But wars are also not productive because you don't do anything with wars. They don't create productive outcome. And so I love this Margaret Thatcher quote. This is the problem with government debt is that eventually you run out of other people's money. Now, you can see it in the US. If you look from where 2008 starts, 2008, there's a global financial crisis. And so therefore, to bail the US out of that particular period, debt increased. And you can see that debt in terms of QE and all of those TARP and all of these programs. Then in 2020, there was COVID. Again, there was another recession. And again, the US government had to also put money and borrow. And so And again, you can see the debt increasing. And so those two dots at the end are the projected government debt level increases. And so why is the US government under pressure? Why are they worried about the deficit? Because actually they've got high debt levels that are continuing to increase as they refund debt that they raised back in 2008 and 2020 at much lower rates. And actually they've got financial pressure in the system. Now, the problem with debt is okay when interest rates are low. And from 2008 over here, you can see two particular lines. The first line is government defense spending. That's the green line there. The US is the most powerful military in the world. They spend the most on defense. And so you can see that it's the second biggest expenditure item on the US's balance sheet. The first being Medicaid and all of those kind of things. But what's happened now is that because from 2008, interest rates basically went to almost zero, actually interest costs, you could borrow and you pay nothing. And so that was easy. The problem in 2020, as inflation came, interest rates then obviously increased and the cost of government debt. And so now you can see the US government is spending more on interest than it does on the military. This then creates financial pressure. That financial pressure means it actually threatens the US dollar as a currency, but also that financial pressure is why they need more revenue and less costs. And that's again, that's why we're seeing all of these actions that we're seeing in terms of Trump. And my final slide, actually then, okay, what do you do with this in terms of markets and valuations? Remember the first slide I showed? First slide talked about how the US, the expectations are very high. You're paying a very high multiple for US assets. And we think that market is looking very expensive. Yeah. But when we compare this particular slide, so the green line is the US dollar index, and you can see that particular green line is very high. The last time it was this high was back in the tech bubble in 2001. And so, again, now we've got tech names that are running, and so there's questions around that. So the dollar is very strong, and it started being very strong from 2008, 2009. What's happened also is that if you look at emerging markets versus developed markets, emerging markets are China, Russia, India, South Africa, Brazil. They have underperformed the US. The US, if you wanted to make returns over the last 15 years, you had to be in US equities. And you can see that blue line that in 2008, 2009, the blue line, which is emerging markets, has underperformed for 15 years. And so therefore, for us, we're looking at this saying this dollar is too strong, especially given the balance sheet in the US, but also emerging market equities are too low and too weak, especially given what's going on in the world. And so therefore, our portfolios, which we're going to take you through now with these two particular shares, actually we have sought exposure to emerging market shares that will benefit from any form of correction in the US or a weakening of the US, and actually any strength, and obviously any strength then in terms of emerging markets.
Great stuff. So that's very great context, like quite comprehensive actually. I haven't heard someone explain it so well and eloquently around some of these key drivers, because when I heard that announcement last week, Monday, it's like 10% is a lot, you know, in such a short space of time, driven by policies. And you mentioned emerging market performance, and China has been quite topical around having a potential tariff imposed of about 20%, I think. So Meryl, before we delve into Tencent and Naspers, in your view, which sectors and industries do you believe are most vulnerable to some of these increasing tariffs in the US, and which ones do you think will be a lot more resilient in your view?
Chinese specifically, or in general?
In general, maybe emerging markets and then specific into China.
Yeah, I think, well, first of all, we can't rule anything out because this is Donald Trump. So as it escalates, we'll see. Maybe there won't be, after a period of time, any sector that is safe. But I think there are specific sectors that the US seems to consider strategic. And that would be anything that they see as a matter of national security or anything with potential military application. And I think that is why we've seen so much intervention in tech and hardware space. The other question is around green transition and energy security. We know that China has all but locked up the supply chains related to battery technology, all the components as well as the raw materials that go into that. 80% of it comes out of China. So I think we will continue to see intervention there, which makes sense. And I think the drill, baby, drill is maybe a response to that, because the US actually needs time to firm up and build out their own green transition supply chain.
Yeah. And just on China, so you touch on like the tech sector as well. Do you think it's going to be a lot more resilient when it comes to these kind of like shocks that are happening in the market at the moment? I know we're going to delving into it a little bit further, but just broadly tech speaking in China, how do you envision it, envisage it?
Yeah, I think what I'll go into is what has been going on in China is a similar amount of investment, research, etc., and innovation, which I think is overlooked because the US grabs the headlines. But I think the interesting part is the starting valuations for, well, almost any Chinese company, but China tech versus US tech is quite stark. So I think for investors in China tech today, the starting valuations are just very compelling compared to US tech.
Excellent. And moving on to you, Gustav, Sibo touched a lot on how there is a lot of key shifts in the US economy. Is there a chance to be opportunistic when it comes to emerging market stocks, given that they haven't been performing well and the assumption is that they could be cheaper and now is the time to buy in?
Yeah, hi there. Hi, everyone. I would agree with that. I think it will be very specific to certain companies and certain geographies. Obviously, emerging markets is a broad statement, but there are economies that are net importers of commodities and others are net exporters. They will be treated differently. But there's definitely an opportunity, in our view, to exploit some of that, to look at economies that are probably more used to the volatility that comes with high inflation and high interest rates than some of the developed market countries. And these will turn out to be more resilient, combined with the fact that many of them have got stronger balance sheets at the moment than the developed market countries. So I once read this quote which said, perhaps in future the emerging markets are going to be the adults in the room, because inflation and this type of volatility is not such a big concern for them. It's part of their history. So yes, we think there's a great opportunity in that for investors who are willing to maybe initially look a bit different from the market and not run with the herd, but rather kind of think independently and do their own homework.
Great. So Meryl, let's take a deep dive into China and China tech. China offers a lot of amazing opportunities, and you've alluded to some of them, but there's oftentimes this disconnect between how investors see the short-term economic signals. Like one of the big ones was there hasn't been a very big government stimulus in the past couple of years, and then they also have a very strong long-term strategic vision. What's your take on this mismatch?
Yeah, I think the historic playbook for China since 2001 has been this infrastructure drive and construction-led growth, investment-led growth, which clearly massively benefited the commodity market and resource companies. And for some time, we've been in the market speaking about the transition that the CCP, the Communist Party, seems to be determined to fulfill, which is away from that infrastructure-led growth towards consumer growth. So I think the lack of that expected stimulus, big bang, let's go out and build approach, I think that forms part of what they have been signaling, that actually there's been overbuild, the property market needs to cure itself, they're not going to keep over-investing, and they need to focus on improving the quality of lives of Chinese consumers. So we think that's where you see more targeted stimulus coming through, like incentives, trying to actually incentivize purchases of hard goods, for example. That's what we've seen in the last few months.
And is there a good example is this launch of DeepSeek earlier this year? Talk us through some of your analysis around this.
Yeah, I think for example, you talked about, we've been talking about tariffs. I think tariffs are part of a bigger picture of trade wars between the US and China. And I think the US and the S&P in particular has been driven by the tech stocks. If you zoom in on that, what has been driving that really has been the AI narrative over the last year or so. Before that explosion of, say, ChatGPT, we were talking about how even the US tech market is looking mature. They're starting to compete with one another. There's more scrutiny around their monopoly status. Should big tech be broken up? And then, boom, we had ChatGPT and we had NVIDIA taking off, and a lot of that focus going there. I think the narrative there was China is being left behind. In the next tech wave, China is being left behind because it's an AI-led wave. And probably to try to reinforce that, we saw, or to make sure that happens, we saw the US, for example, putting trade restrictions in place around China importing chips, the chips being necessary to actually develop large language models. And yet, so we saw that heating up in December 2024, yet then at the end of January, we see the launch of DeepSeek. So despite the US trying to run interference on Chinese AI development, they still launched something which, by all accounts, is more cost-effective and potentially significantly lowers the amount of chips that you even need to use. So maybe that was a response to austerity that was imposed by the US that actually fueled some innovation. And I think if you zoom out even further, I think ChatGPT, Claude, we can go through all the consumer-facing large language models that captivated the imagination for the last year and a half. I think it has created this idea that this is a US phenomenon only. But if you actually look over time since 2012 at AI-related patents granted, this chart shows China in the red and US in the blue, cumulatively, so every year adding on to the patents landed the previous year. The data up to 2022 shows that China had actually 3 times as many AI-related patents as the US. It's just a question of, were those the ones grabbing the headlines? Most of the focus was more business to business application, improving efficiency internally within corporations, rather than necessarily us asking ChatGPT, help me plan my holiday. So I think they haven't captured the imagination, they haven't captured the headlines. They seem to be more focused on corporate application than individual application, whereas the US was individually focused. In 2024, and this was just the first 10 months, we saw again China in that year alone had done almost 13,000 patents versus the US of 9,000. And I think this is somewhat underappreciated, and the AI narrative really drove the US tech stocks to new highs, while at the same time China stocks were derating because of anti-China sentiment, not necessarily just the tech space, overall China sentiment, but I think that created quite a gap. So yes, ChatGPT caught everyone's attention in November 2022, but less than a year later, Tencent, and we are owners of Process and Naspers, of which the largest, their largest investment company, investment holding is Tencent. Tencent launched their version, let's say, of ChatGPT.
Interesting.
I'm not sure I'll probably pronounce it wrong. Hunyuan. Let's give it a try. Less than a year later, and not out of the blue, as per the chart before, there had been this innovation and R&D
Happening in the background, yeah.
It's just that it was overlooked, and everyone sees Tencent as, oh, it's a gaming company. It's going to miss out on the AI wave. No, that's not true. And we've seen in recent months a bit of closing that valuation gap where the Mag 7 has derated a bit, Chinese tech has re-rated a bit, but actually the gap is still quite large. I think it still sits at 35%, whereas in the past they have traded closer to parity. So I look at this as, I think more than 6 months ago I was being asked, is there any way that a JSE investor can access the AI theme, because the action seems to be in the US. Well, you can access it via China at a discount, in fact. Yeah. And then this is just a reminder that Tencent as a whole, why do we hold such a big exposure to this? All the themes in tech that are playing out in the US, be it the data centers, cloud, AI, as well as the social media, the video entertainment, etc. China actually is Tencent is an amalgamation of all of those avenues within China. It's a massive addressable market that is still growing in its wealth per individual. And, well, due to regulation, many of these US players are not actually allowed to play in that market. So they have a walled garden in which to tap into that market.
And just out of interest, does Tencent, with their AI play, have the intention to create a more market-facing, say, solution? So if you take ChatGPT, I think all of us, we go between three of these apps. But yet, China is a very inward-facing economy with a large population. But do you think there's an intent for them to go to market whereby that equivalent of Tencent can also be in our AI options that we use on a day-to-day basis?
Outside of China?
Outside of China.
Very interesting question. I think, first of all, DeepSeek is quite new. They are releasing, I think there's already been a revision to the first model that was released in Jan. So in China itself, we're seeing very rapid adoption by corporates. China, or Tencent's own answer to WhatsApp,
Yes.
the chat app is incorporating it. And what we're seeing is even US companies and startups experimenting with DeepSeek
Yes.
rather than the US alternatives. And part of the reason is the cost differential. And the other reason is that the languages are open source, so it's more collaborative. It's less, the rate of improvements could actually be higher and cheaper than some of those original, like the ChatGPT, because it's so controlled, because it's closed source. So I think it's possible, and I think the US will most likely try to slow that down. Because I think there's a lot of fear around having a Chinese language model embedded in software globally. Yeah.
Interesting. Now, coming back to you, Sponiso, given Meryl's insights on Tencent serving as a gateway to AI development at a discount, how does the China tech story fit into your broader global investment strategy right now?
Yeah. So, I think similar to what Meryl said, I think one thing that Chinese tech has, which I suppose the US tech probably lacks, is a large domestic addressable market. So, because the Chinese population is 1.3 billion people. And also what then Tencent has, which is an amazing strength, is what's called a super app. In the sense that I suppose Facebook is trying to make WhatsApp a super app, an app where everyone goes in and then that filters you everywhere. That's the competitive advantage of Tencent. And so when we look at it then and say the Tencent actually has rarely been a forerunner or an innovator of products or apps or anything. But its ability to duplicate and then put things out to a very large populace is actually very good. It's very effective. That's why it's in almost everything in terms of the market. So when we look at it, we don't look at it, I agree with Meryl in saying that, yes, the US seems to have gone first in this, but that's because actually we are exposed to the Western way of the world. And actually, if you look at the number of patents and you look at what's actually going on, China's ability to replicate at a lower cost actually has always been their strength. And so we are starting to see that. So for me, it actually fits firmly in our view that whatever the US is going to do, China is generally going to copy and do it much better and much cheaper.
Now, moving on from tech to beer, we're going to talk about all things AB InBev. Gustav, AB InBev has had a stellar performance in the past year with their results coming through quite recently, where they recorded $16 billion in revenue and $20 billion in EBITDA. How are they managing the balance between driving profitability through, being disciplined around costs and margin expansion versus being more innovative, or are they being innovative? What's the key driver behind these two really good numbers that we're seeing in their financial performance?
Sure. Thank you. Yes. So if we just take a step back in terms of AB InBev and look at what the company is, it's as you correctly stated, global brewer that's very well diversified globally and has an exceptional strength in the marketplace, good margins, and a wide range of products. So as the viewers can see on the screen, what we have is a business that is not focused on one geography. It's not focused on one currency, which is one of the attributes that we like. There's very few options that we have on the JSE to invest in companies that are rand hedges, but not necessarily pound or US dollar exposed. AB InBev gives us an opportunity to Sibo's earlier point on emerging markets to get significant exposure to Mexico, Brazil, these kinds of areas which are rand hedges but don't have the same drivers as the dollar or the pound or the euro. So the diversification benefits are immense. To get to your point in terms of how the business is run, if you look at the history of AB InBev, it has an exceptional track record of keeping costs low, being the highest margin producer globally, even if all their products are not the highest priced in terms of revenue. It's a business that was built with a view on costs. And what they've done subsequent to the acquisition of SAB and the other acquisitions that they made is they have decided to move with the times and invest a lot into alcohol-free beer, hard seltzers, tech platforms, which they call BES, B-E-S, whereby merchants can order. So they've really invested in tech. They've invested in the kind of newer age drinks like non-alcoholic alcohol and more healthy options like hard seltzers, along with stellar brands such as your Coronas and your Budweisers and your Stella Artois that are still enjoyed globally by the masses. If one looks at why we enjoy the exposure and think there's an excellent opportunity for clients in this one, is the market became very excited about Anheuser-Busch when they took over SAB. Our view was that they overpaid for that acquisition, and subsequently the chickens came home to roost, and the market unfortunately started realizing that this was going to be a problem, and the share price wasn't compensating you for that risk, and the price came down from $130. What we like is the fact that us buying it recently, we don't have to pay for that mistake. because we can buy it at $50 equivalent. And it's a business that remains exceptionally well run, very strong, and your typical quality on sale. Fixable problem, short-term problem. We also like the fact that management were making all the right decisions to create shareholder value. They were not scared to cut a dividend when it was needed, to rather pay down debt. They are very amenable to share buybacks if the share is trading at a low value. They're very, very focused on the long game in terms of the business. And one can see that through the actions that they take in terms of their balance sheet structure, etc. When you combine that with short-term hiccups, like the Bud Light marketing problem that they faced a year or two ago, the COVID impact on their input costs, and the fact that on-premise globally was almost zero for that period. People couldn't go out and have a beer, so it was more at home, which impacts their volumes. And then also the strong US dollar negatively inputs their input costs, given that they sell beer in emerging market currencies and they pay for many of the input costs in US dollars. When you bring all of this together, we have a situation where we have a wonderful opportunity. Often we are then asked, what about the debt? Anheuser-Busch has a lot of debt. And optically, yes, it is a lot of debt. Our explanation to clients is then, yes, but if we look at their debt, they've brought it down by $44 billion in the last 7 years. Okay? That is without sacrificing spending on maintenance capex, on their brands, on their logistics network. And what's even more important here, and where we think a big opportunity is that the market could be missing, is that the debt is exceptionally well structured. They have zero bank debt. So in any crisis, there's no banker that's going to come knock on the door and say, we need you to pay back the debt. It's all fixed interest and bonds that they've issued, first of all. Secondly, there's no floating rate debt. It's all fixed rate. So when they issue the bond, they agree a rate, and that cannot change regardless of what happens to interest rates. And then they match their debt with their profits in terms of currency, so that you don't get a situation where one currency goes against you and your debt is in a different currency, as we've seen with other companies in the last few years. And then finally, they have these fixed maturities, so they constantly keep the window of repayments, the short-term window of repayments, open, so that there's very little debt that's due in the next 2 or 3 years in case there's a crisis. So you can see 61% of their debt is payable only after 2034. So you've got 10 years before 61% of your debt starts becoming due. So this gives us an opportunity to buy a business where there's an ownership mentality, high quality, low price, fixable, temporary problems, in our view. How do they pay off this debt so quickly? Well, ABI is one of the fortunate businesses where the free cash flow is actually higher than the profit, the net profit after tax. We always like to remind clients that cash flow is a fact and the accounting profit is merely an opinion. So if you look on the screen, one can see that the blue line is the free cash flow margin, which is consistently higher than the net profit margin. And this is because of their working capital cycle and their depreciation policies, which allows them to actually generate more profit than you see in their earnings per share. More cash profit. So the money in the till is more than the financial statements say. And this is the money that they can use to do buybacks, pay back debt, and pay a dividend to shareholders. So yes, it's a company that we think is materially underappreciated by the market, and will potentially do very well for clients going forward.
Okay, thanks for that. So, Sivo, Gustav's painted a very good picture of AB InBev, but as the CIO, what keeps you awake at night about the stock? Are there any risks that investors should be aware of, if any?
Well, any share that trades at a material discount actually has risks in it. And in this particular one, I think if you look at the risks that have material, investors, like Gustav is saying, are worried about the debt. They look at the debt and they say, oh, that's a lot of debt. And it is a lot of debt. And it has been a lot of debt. But I think from our side, we've got to look deeper than that and say, actually, how is that debt structured and when does it cause pressure? Just like I was talking about the US, the US debt is causing pressure today. That's why their actions are immediate. The Anheuser-Busch InBev debt, that is well-structured debt. There are no covenants to it. It's probably one of the best structured debt in companies. So that doesn't bother us. So the devil's in the detail when it comes to financial analysis. And so for us, it can't bother us. There's obviously always the risk. It's a company that operates in various geographies. And actually, if you look at Anheuser's earnings over the last few years, one of the biggest headwinds to its profitability has been the dollar. Because actually, if you look at it, the dollar's strength hasn't favored this as a particular company, given the fact that it buys its raw materials in dollars, which is then aluminium, et cetera, and obviously the wheat and the barley that it makes the beer with. That's also all priced in dollars, yet its revenues, it operates in countries like Mexico and Brazil and South Africa. And we know what's happened to all of those currencies. They've been similar to the rand in terms of they've been depressed. And so therefore, if the dollar keeps going, that's going to continue to add headwinds. And so that is a risk to that particular company. But clearly, as I showed you in that particular slide, the dollar already looks high. So for us, the price we're paying today for access to Anheuser-Busch's profitability discounts quite a material part of the risks that we see in the investment case.
Awesome. And Meryl, for an average investor, how would you suggest they approach adding something like AB InBev or something similar into their portfolio, given all these fundamentals Sibo and Gustav has given us about the stock?
The cheeky answer is just buy the investors fund because it's one of our highest conviction holdings. But I think one always needs to do your own homework, have a handle on what you think is a fair multiple, even if it's a back of the envelope calculation of what the earnings growth is going to be and what multiple you're willing to pay. And then I think it is a consumer staple. So I think the volatility is not typically very high in this share. So it can form sort of a core, it can play a core role in a portfolio. And I think watch the narrative. So management has said they're going to de-gear, they're not going to do big acquisitions, they're going to grow through internal innovation. If they start to deviate from that, reconsider the investment.
Excellent. That's an honest answer, and thank you for that. So before we jump into the Q&A and before we go into closing remarks, we encourage you, the audience, to please just send through your questions. So just in conclusion, Gustav, I'd like to start with you. So in your view, should investors remain overweight or look into being underweight SA Inc., given the current macro environment? We spoke a lot around trade tariffs. There's a lot that's been happening locally as well that we haven't delved into. What's your view around SA Inc.?
I think there's quite a bit around that topic. I don't necessarily think it's as simple as SA Inc. or not. I think what's happened post the GNU formation, we've kind of let the steam off and things have normalized a bit. We are probably now more in a stock pickers market than a broad-based SA Inc. is cheap and will do well. I think there are fantastic opportunities in SA Inc. stocks, as we call them, where profits are, the market is underestimating how low profits are given the meager growth we've had in the country for the last 10 years. And you've had these very good companies have to cut their costs and become so lean to survive that should the economy now lift its head, and you have the tailwinds of maybe a bit of a stronger rand and lower interest rates and so on, you could have profits materially higher than the share prices imply. I don't think that's the case for all companies. I do think there are companies in SA that are probably getting a bit ahead of themselves. And I think if we look at the last 10 years in terms of the flows into passive, the flows into certain sectors of certain markets, it has been very one-sided. I do think in the US, in emerging markets and in SA, investors are going to have to pick carefully, do some homework and rely less on broad cyclical tailwinds.
Thanks for that. And Meryl, how do you see China's tech sector evolving in the next 5 to 10 years? I think Sibo alluded to it to say like they're very quick to be very responsive. They're quite an agile economy when it comes to development. So how do you see them, developing in the next 5 to 10 years, and what impact will it have on global investment strategies?
Yeah, I'll reiterate the point about starting valuations, because I think that can have a bigger impact than even the underlying results. So given where US tech valuations are now and how big a part that is of the US market, I think there's very little room for that to disappoint. So that could benefit almost any other market on a relative basis. And then on the flip side, China is depressed, and China tech is depressed, and I think has been underestimated. I would expect the innovation to be used both in the companies themselves to improve productivity, but also if you think about how the advent of the personal computer operating systems like Microsoft, etc., what that has done for productivity within the business world. So imagine what that does for, what AI would do, and then that in China, where there's an ability to just rapidly deploy and roll things out. It could have very interesting implications for their economic growth and productivity relative to the rest of the developed world.
Thanks. And lastly, Siboniso, what would be your one-sentence takeaway for navigating the chaos in the market at the moment?
Pay attention to starting valuations. The price you pay in any asset actually is one of the biggest determinants of your future value. And actually how I'm going to elaborate on it, building onto Meryl's statement, is that the US tech sector has been magical actually over the last, 4 or 5 years. And it's driven quite a material amount of ratings. But if you look at some of those companies, so if you take NVIDIA, Apple, and Tesla, their profitability has not grown as fast as the earnings re-rating. So the PE ratios have gone far ahead of what the underlying profitability has been, because the market is expecting them to continue to grow. So the expectations are super high. And what we've seen in the US, they obviously had their own reporting period of a few weeks ago. The Magnificent Seven companies, all those tech companies, actually we saw for the first time in about 2 years, them not exceeding the market expectations.
Yeah.
And so in aggregate, actually they met market expectations rather than exceeding them, and some of them disappointed. And hence, we have not seen those share prices continue to go higher, because what the market guessed the earnings were going to be was exactly a little bit of disappointment. And so therefore, that's why we're starting to see those shares coming down, because the market is saying it went ahead of itself, and now it's coming back to reality of the fundamentals.
And I suppose there's going to be interesting competition coming up, like where out of the blue we have DeepSeek, and I think NVIDIA's stock fell quite significantly that day. So there's more to come around things like that. Well, I suppose, that brings us to a wrap, and all I can say is that buckle up, everybody. It's going to be an interesting market or season ahead. We've got a question at hand, and I'd like to pose it maybe to you, Sybil. The question is, the recent political disturbance between South Africa and the USA, how will it affect the the local stock market, and what will it be? What will the medium term and long term look like in your view? And Gustav, Meryl, you're more than welcome to contribute towards that question as well. It's it'll be interesting to get each of your views.
So we've got to step back and look at the local market, the JSE. The JSE, 60% of the JSE is made up of profits that are generated outside of South Africa. 40% is in South Africa. And so therefore, that's why whenever you look at the returns in the JSE, you've got to be aware about where are the underlying profits generated. So if you think about this whole idea of 60% being offshore, what do we mean? Well, the commodities companies, the gold companies, platinum companies, obviously the diversified mining companies, those companies might mine in South Africa, but those products are not sold in South Africa. They then are shipped elsewhere. And then you've got obviously Naspers, which Meryl talked about, the biggest company on the exchange. most of the money that is made by the Naspers group, in fact, all the profits are made offshore. And then obviously Gustav talks about Bush InBev. That's a global company. It makes some money in South Africa, but it's not the most. And so therefore, when you look at South Africa and you talk about the local stock market, we must disseminate that and actually realize that you're not talking about the entire thing. And so therefore, then when we assess then the risks presented between South Africa and the US, then we've got to understand it within that particular context. Now, yes, there's a lot of noise, and in markets, you've got to figure out how to price the noise and how to price the fundamentals. And so for us, we will step back and look at this and say, okay, fine, which companies will be affected by this? Now, the US, I think, is our third largest trading partner, depending, again, on what you mean by trading partner in terms of the US. Then we would go into that and say, okay, fine, what does that actually mean when it comes to investing? So clearly, this will not be, it's not going to be meaningless as an impact to the country, but it's actually very interesting for us to have a look at where the dollar rand is. This noise has been around since Donald Trump came in. And actually, the rand to the dollar, I think when it started, the rand to the dollar was at 1860 or so. Now it's about 1818 as of filming today. And so therefore, the dollar rand has actually been fairly resilient. The other side of it is that, remember what I said at the beginning, that the US dollar was very high. So whenever we think about the dollar and the rand, we always think of it in reference to actually the rand weakening. But actually, if the dollar weakens, the rand is going to get stronger. And we are getting a dollar that is now weakening because the US itself has got its own issues. And so it's a complex question to answer, but just remember, the local market is made up. Hence, today we presented companies that are unaffected by what's going to go on between South Africa and the US. These are both global companies that have got earnings and profitability from elsewhere. So from our side, in the short to medium term, the devil's going to lie in the detail. But just remember that most of what you see in the JSE doesn't make money from South Africa.
And any contribution or anything you'd like to add to that, Miro?
Just an interesting data point where if you take Tencent, I had the chart up on historic PE. It trades at 25 PE for one of the largest tech companies in China. Or you could buy ShopRite on a 25 PE, which sells groceries to 60 million people. So the JSE, it's a rich universe of stocks. So there are always opportunities.
And it's a good, I don't know if you want to bring up that question again. There was another question that we had. It's a nice segue into that question and Gustav, maybe I'd like to pose it to you. It says, with all these global economic shifts, what do you think will change with regards to the appetite for African investments? ShopRite is a good example of an African investment opportunity.
These questions are always tricky because we all have opinions.
Yeah.
The honest answer is we don't know. How we would approach it is, to Sibo's point, firstly, will it change the appetite for African investments? It may not. We don't know how the actions of the US is going to lead to other partnerships, maybe between Europe and Africa, between the East and Africa, between Latin America and Africa, etc. We don't know how those partnerships are going to solidify themselves. It is not as if the US is the only trading partner one can have globally.
Yep.
So one might find yourself in a situation where the partnership becomes very strong between different African countries that have commodities with other countries that need the commodities. So will it change the environment? It'll probably change it. Will it be negative or positive? I think it's too early to tell. It's the same as with JSE stocks. We don't know how it all settles. I suppose that's why I would just urge all investors to remain diversified and not try to react in terms of knee-jerk reactions. All of this can lead to value-destructive decisions. Everyone is emotional about it. If you're well diversified, then in the last 50 years, there have been many reasons to sell stock market, and they've continued to go up. So.
And the last question is directed to you as well, Gustav. It's around, did the Russia-Ukraine war have an impact on AB InBev's bottom line?
Yes, it did. More from what happened to the input costs. So obviously, given the commodities that come out of the Ukraine and what happened post-COVID in terms of inflation, all those commodities spiked. The supply chains were disrupted. They couldn't get cans and glass. They couldn't get their products to different ports because you will remember the congestion in ports and the shipping rates. So yes, it definitely did affect them. Did it affect them permanently and structurally? No. These beverage companies, like all consumer staples, have got quite a lot of pricing power, and they might not be able to pass on 20% pricing increases in 1 year, but they can do 7% over 3 years, and so they recover their profitability. So the answer is no. Structurally, they haven't impaired the earnings power, but over the short term, they did. The conflict did negatively impact profit. Yes.
So that brings us to the end of our webinar, everybody. Thank you so much for tuning in, and a big thank you, Sibo, Meryl, and Gustav, for your valuable and insightful contributions.
Thank you.
Thank you. Thank you. Thanks, everyone.